Hi guys and welcome to our podcast. Today we're going to discuss about the different types of mutual funds. Mutual funds are a great option for inexperienced investors. Basically, this is a pool where lots of different people put their money and an experienced professional manages the fund and invests in different asset classes, securities, stocks, etc. Check out our article written by the great Russell White and find out more about what mutual funds are, different strategies when investing, and their major characteristics. Depending on an investor's goal and the future strategy, there are several different types of mutual funds. Let's look at the most common ones. So these are the common types of mutual funds. Number 1, stock funds. As their name suggests, these are funds investing in stocks. The value of a stock fund is most likely to be volatile and inconsistent in the short term, primarily because prices are dependent on the underlying business and the economic dynamics. However, in the long run, stocks tend to outperform the other types of investment. There are different types of stock funds based on the risk and the potential profit on the stock they choose to invest in. Fixed income funds' primary objective is to focus on buying fixed income securities like government bonds, obligations, and corporate bonds. The aim of these funds is to provide their investors with a monthly income generated by the interest the bonds earn. This type of investment is very common among the elderly and retired because it's safe and guarantees a stable additional income. Is it risk-free? Nothing is. For example, prices of bonds depend on the movement of interest rates. If rates go up, bonds go down. Another risk is the borrower defaults on their payment. Income funds' main goal is the provision of income. That's why they invest in stocks that would pay a regular dividend. Index funds invest in portfolios of stocks designed to mirror and track the performance of a particular market index, such as the Nasdaq Composite or the S&P 500. The stocks are interconnected with the index, and their performance is entirely dependent on it. Many people prefer it due to its minimal management costs and fees. Usually, this type of investment is considered a passive one because a fund just purchases all shares making up an index. There are a couple types of stock funds. Growth funds invest in undervalued small-cap companies with above-the-average growth because their primary goal is capital appreciation. Value funds invest in stocks of companies that are considered undervalued because they want to have a greater safety and potential for appreciation. Blue-chip funds' main goal is income and safety. That's why they invest in well-established and financially solid companies. Sector funds invest in a particular area of the economy or an industry, such as technology, healthcare, real estate, agriculture, etc. These funds usually offer higher appreciation potential, but there's also a higher risk involved due to the lack of diversification. However, some investors choose to put their money on them on account of their specific knowledge in the sector, or they could predict its bright future. There are many sectors of stock funds. Let's cover some of them. Green funds offer an investment in green and environmentally friendly companies, e.g. renewable energy sector. Even though they avoid investing in conventional companies with a less environmentally friendly attitude, it's arguable if they yield returns worth investing. This investment scheme has a more symbolic value than a real one, representing a more socially and environmentally responsible approach. Cyclical funds invest in stocks whose value is driven and affected by the economic ups and downs. For example, enterprises that are hugely dependent on discriminatory spending, such as hotels and airlines, tend to see their stock values rise when the economy is strong, because people have greater spending power. And vice versa, when the economy is weak, people cut spending that's deemed unnecessary, which leads to lower earnings for businesses that sell discretionary items and services. This, of course, results in a decrease in their stock value. Qualified dividend-paying stock funds are mutual funds which invest in companies whose stocks distribute their shareholders a qualified dividend. This is yet another low-risk, passive investment opportunity. Therefore, these funds suit primarily retired individuals due to the stable income they offer. But this is not the only reason. Often the taxes imposed on the dividend are lower than the fees one should pay when withdrawing from their retirement account. In composition to bond funds, these are not as profitable but have a greater potential for increase of the value of their asset. As an example, Goldman Sachs Growth and Income Fund is currently yielding about 1.5%, but its total returns through October 31, 2006 is 17.5%. On the other hand, foreign companies often pay a higher dividend, which encourages funds to invest in their stocks. For example, Alpine Dynamic Dividend Fund yielded 12.6% through October 31st, with total gains of 14%. Different types of mutual funds are bond funds. This type of mutual fund primarily focuses on bonds. Investors often choose this option because it's relatively low cost, which allows to easily build a diversified portfolio. You can include different classes of bonds with different maturity: investment grade, corporate, junk, government, sector, international, gold, and precious metals. Generally, there are two types of bond funds. Government bond funds buy government securities, treasury bonds, agency securities like Freddie Mac or Ginnie Mae. Usually government bonds are considered risk-free because they're backed up by the country. These funds guarantee their investors a stable income in a relatively safe environment. It's valuable to know that, in contrast to safety they offer, there's a minimal opportunity for capital gains. Municipal bond funds, also known as tax-free or tax-exempt, invest solely in municipal bonds. Their type depends on the objective of the fund. What they offer is a return free of federal taxes. And if an investor is a resident of a particular state, they're also exempt from state taxes. The opportunities these funds offer are quite limited. Usually, this opportunity is preferred by people who live in states imposing high taxes on their residents: New York, California. Now let's discuss the risks associated with bond funds. There's always a serious risk of a borrower to default on their debt, which means they can't keep up with their payments. This is defined as credit risk. It depends on the borrower's credit rating. According to this, U.S. Treasuries pose a little risk, while corporate bonds are not as safe and predictable. Having bonds in mind, we have to consider interest rates. The basic rule is simple: if rates go up, the value of bonds go down. There is a strong and unbreakable connection between bonds and rates. Keep in mind that the longer a bond's maturity, the greater the risk. Nevertheless, compared to stocks and their prices, bonds are not as inconsistent and volatile. There is another risk associated with bond funds: prepayment risk, and it's closely connected to movement of interest rates. If they go down, the chances are that a debtor would like to preliminarily pay off their debt, which accordingly causes loss in interest on the bonds. The third type of mutual fund is money market mutual funds. The strategy of this type of mutual funds is to purchase fixed income securities and earn an interest for the investors. The income they produce is paid out in the form of a dividend. Experts think that this is one of the safer options and possesses a lower risk. They usually invest in debt securities with a minimal risk and short term, without a commission or charge when selling. In addition, they're highly liquid, which makes them attractive for investors who need cash. In the USA, their net asset value is kept to $1 per share. One of their drawbacks is that these funds are not insured by the Federal Deposit Insurance Corporation, or FDIC. Moreover, inflation and negative interested rates might also have a negative effect on the yields they earn. Another and last kind of mutual funds is the target date fund. These are mutual funds which have a target date, as their name suggests, including a mix of different asset classes: stocks, securities, real estate. Primarily the date which this fund is aiming at is retirement. Approximately 90% of the cases are in retirement accounts. Fidelity Investments, Vanguard Group Incorporated, and T. Rowe Price Group Incorporated are the three most powerful target date mutual funds. Examples: initially, Vanguard funds invest 90% in stocks and the remainder in bonds. As the target date draws near, the ratio is 1-to-1, 50% stocks and 50% bonds. When starting, Barclays LifePath has the same strategy in the beginning: 90% stocks, 10% bonds. However, when approaching the target date, the ratio is different: 35% stocks and 65% bonds. Expenses vary from fund to fund. For instance, expense ratios range from 0.21% to 1.25% or more. Use all cautious for the tired bull to end. That's it for now. I hope you enjoyed, and don't forget to subscribe to our podcast channel on YouTube. We'd love to know your thoughts, so feel free to share them on the comments below.